If you've been saving in a 401k or a traditional IRA your whole working life, there's a rule waiting for you at the end of it that almost nobody explains in plain English. It's called a required minimum distribution, an RMD, and the headlines love to make it sound like a trap. So let's do what we always do here. Calmly. Here's the whole idea in one breath. For years, the government lets you put money into your retirement account before tax. That's the deal with a traditional 401k or IRA. You got the tax break going in, and your money grew untouched. But the IRS was always going to collect its share eventually. So once you reach a certain age, they require you to start taking a minimum amount out each year, and you pay ordinary income tax on what you take. That's all an RMD is. It's not a penalty. It's not the government taking your savings. It's simply the bill finally coming due on the tax break you already enjoyed. The money is still yours. You can spend it or move it straight into a regular account and keep investing it. You just can't leave it hiding from taxes forever. Let's be clear about which accounts we're talking about, because this trips people up. RMDs apply to your tax-deferred D accounts, traditional IRAs, 401ks, 403bs, 40357 plans, and SEP or simple IRAs. Those are the ones you funded with pre-tax dollars. What's not on the list is just as important. A Roth IRA has no RMDs at all for you, the original owner. Your money can sit there untouched for life. And as of 2024, Roth 401ks dropped their RMD requirement too. So if all your savings are in Roth accounts, this whole episode is just useful background. For everyone else with a traditional account, this is the rule to know. So when does this begin? As of 2026, the magic number is age 73. When you turn 73, you're in RMD territory. And there's a special twist on the very first one. Your first RMD isn't due until April 1st of the year after you turn 73. That sounds generous. A few extra months. But here's the quiet catch. If you wait until that April deadline, you'll end up taking 2 RMDs in the same calendar year, the delayed first one, plus the regular one due that December. 2 withdrawals stacked into one tax year can shove you into a higher bracket. So for most people, the calm move is to take that first RMD in the same year you turn 73 and keep it to 1 per year after that. Every RMD after the first is due by December 31st. Mark it on the calendar. Late December is not when you want to be scrambling. And one more thing worth knowing, that age is scheduled to rise to 75 in 2033, so if you're younger, the goalposts may move. Verify the current age when your time comes. Let me make this real. Margaret just turned 73 this year. She's got about $400,000 in a traditional IRA from decades of steady saving. When she heard the IRS makes you take money out, she pictured some huge forced withdrawal. The reality was much gentler. Her first RMD worked out to roughly $15,000 for the year, a little under 4% of the balance. She took it in December, paid the ordinary income tax on it, moved the part she didn't need into a regular brokerage account, and kept right on investing it. No drama. The scary headline and the actual experience were 2 completely different things. So how did Margaret's $15,000 get figured out? The math is simpler than you'd fear. You take your account balance from December 31st of the previous year, and you divide it by a number from an IRS chart called the Uniform Lifetime Table. That number is basically your life expectancy factor. At 73, the factor is around 26.5. So Margaret's $400,000 divided by about 26.5 gives her roughly $15,000. That's it. As you get older, that factor gets smaller, which means the percentage wage you have to take slowly rises over time. A little under 4% in your early 70s, creeping up as the years go on. Your IRA custodian, the company that holds the account, will usually calculate the number for you and even put it right on your statement. But it's smart to understand where it comes from, so it's never a mystery. Now, the part the headlines love, the penalty for missing an RMD. For years, this was genuinely harsh. A 50% excise tax on whatever you failed to take. 50%. That's the number that built the fear. But here's what those scary videos often leave out. The law changed. Under the SEC Cure 2.0 Act, that penalty dropped to 25%. And if you catch the mistake and fix it promptly, usually within 2 years, it falls to just 10%. And the IRS is genuinely willing to waive it entirely if you missed it for a reasonable cause and corrected it. You file a Form 5329, with a short letter explaining what happened, take the missed amount, and in most honest cases, they forgive the penalty. So yes, you want to take your RMD, but a single honest mistake is fixable, not financial ruin. Breathe. Here's a practical detail that saves people real headaches. What if you have more than one account? Say you've got 2 traditional IRAs and an old 401k. The rule works differently depending on the type. For your IRAs, you can add up the total RMD across all of them and take the whole amount from just one call IRA if you want. That's called aggregation. Convenient. But 401ks don't get that flexibility. Each 401k has to have its own RMD taken from that specific plan. So a common move, well before RMD age, is to roll your old 401ks into a single IRA. One account, one RMD, one number to track each year, instead of juggling several. Simpler is safer, especially as the years go on. Now let's talk about paying less tax, because that's where the real win is. The first lever is the best-kept secret in retirement giving, and it's called a Qualified Charitable Distribution, a QCD. Here's how it works. If you're at least 70 and a half, you can have money sent directly from your IRA to a charity you care about. Not to you first, straight from the custodian to the charity. Why does that matter so much? Because that money counts toward your RMD for the year, but it never shows up as taxable income to you. Think about that. Normally, an RMD lands on your tax return, raises your income, and can ripple into higher taxes and even your Medicare premiums. A QCD does the giving you were already going to do, satisfies the RMD, and skips the tax bill entirely. As of 2026, you can give a sizable amount this way each year. Verify the current limit, it's well over $100,000. For anyone charitably inclined, this is the single cleanest way to shrink the tax sting of an RMD. Tom and Linda are 74, and they tithe to their church every year anyway, about $8,000. They used to do it from their checking account and take their full RMD on top, paying tax on all of it. Their advisor pointed out they had it backwards. Now they send that $8,000 straight from Tom's IRA as a QCD. It covers part of their RMD, and that $8,000 simply vanishes from their taxable income. Same gift to the same church, but now the IRS isn't taking a cut on the way. They didn't earn a dime more, they just stopped overpaying. That's the whole game with RMD planning. The second lever is about timing, and it's why we're having this conversation calmly instead of in a panic at 73. The years between retiring and starting RMDs, often your late 60s to early 70s, are a quiet window. Your paycheck has stopped, but the RMDs haven't started, so your taxable income may be the lowest it'll ever be. That low-income window is the perfect time to do a little planning. Some people do Roth conversions in those years, moving money from a traditional IRA into a Roth, paying tax now at a low rate, so that money never has an RMD again and grows tax-free for good. We did a whole calm episode on Roth conversions if you want the details. Others simply take a bit extra from their IRA in low-income years to smooth things out, so they're not hit with a giant RMD and a giant tax bill all at once later. You don't have to do anything fancy. You just don't want to sleepwalk to 73 and get surprised. One more useful exception, especially if you're not fully retired. If you're still working past 73 and you have a 401k with your current employer, you can generally delay RMDs from that plan until you actually retire, as long as you don't own a big chunk of the company. Your old accounts and your IRAs still follow the normal rules, but the plan where you're actively working can wait. So if you love your job and plan to keep at it into your 70s, that's one account that doesn't start the clock until you do. A small thing, but it can buy you a few flexible years. Here's the part that ties everything together, and it's why planning early pays off. An RMD doesn't just cost you the income tax on the withdrawal. Because it raises your total income for the year, it can quietly trigger two other things we've talked about on this channel. First, it can push more of your Social Security into the taxable column. And second, It can bump you into a higher Medicare premium bracket. That's the IRMAA surcharge we covered in an earlier episode, usually with a 2-year delay. So a big, unplanned RMD can echo into your Social Security taxes and your Medicare premiums down the road. That's not meant to scare you. It's the opposite. It's exactly why smoothing your income before RMDs begin is the calm, smart play, instead of letting one big withdrawal set off a chain reaction. So let's make this simple and doable. Here's your calm checklist. 1. Know your age. As of 2026, RMDs start at 73, so find your year. 2. Roll old 401ks into a single IRA before then, so you have one number to track, not 5. 3. In your low-income years before 73, ask whether Roth conversions or smoothing make sense for you. 4. When RMDs start, take that first one in the same year. Don't let two stack up. 5. If you give to charity, give through a QCD straight from your IRA, not from your checking account. And 6. Set a calendar reminder for early December every year, so the deadline never sneaks up. That's it. 6 steps, mostly done once, and the whole thing goes from scary headline to quiet routine. Let's bring it home. An RMD is just the IRS finally collecting tax on the break you already got. Not a penalty, not a grab. It starts at 73. It's your year-end balance divided by a life expectancy factor, and the penalty for slipping is far gentler than it used to be, and usually forgivable. Roth accounts skip it entirely. And you have real levers. Give through a QCD. Plan in your low-income years. Roll accounts together, and watch the ripple into your Social Security and Medicare. Knowledge turns this from a trap into a checklist. If this made RMDs feel calmer and clearer, do me a favor and send it to one person who's getting close to 73 and losing a little sleep over it. None of this is advice, just the plain rules and examples, and the figures are as of 2026, so verify the current numbers at irs.gov. Take a breath. You've got this. I'll see you in the next one.